Did you know that renters have less than 3% of the wealth of homeowners? Well, it's true, at least in the United States, right? According to the Aspen Institute. In case you didn't know, net worth is determined by the value of your assets less your liabilities and or your debt. One of the most reliable ways to establish or at least increase your net worth is by owning real estate. Obviously, you can just own the real estate, in terms of just living in it. But when you're kind of starting out and you're looking to kind of build your net worth, arguably a much more wise decision is to actually have a rental property. And that's because there's a lot of expenses involved with actually owning a property. If you think about just the concept of mortgage, interest, principal, taxes, and insurance, those are 4 line items, and then you'll have to be paying that out of your pocket as you live in it. And then also other things like maintenance and repairs. There's also electrical, there's water, and then there's, of course, in this day and age, there's internet and cable. And then if you have things like a pool, you'll have, basically a pool repair person and then also a pool cleaner, right? So the fact is that this can be very expensive if you actually live in it. That's why a lot of people will consider their first piece of real estate to be an investment property, because that way you can get rental income to pay for all of those line items. So the spirit of this video is why net worth explodes after one rental. And, like I said, it's commonly understood that having your first rental property is generally, a strong way to kind of start out and explode your net worth. Basically, in general, why that is, what we're going to do is I'm going to go in and I'm going to show you just really 2 simple illustrations, right? First, we're going to look at asset appreciation. So we're going to just look at net worth according to asset appreciation. So for the most part, on average, property values in the U.S. go up. And this is, certainly even before the pandemic of 2020. Basically, you'll have, years similar to, like, let's say 2007 to 2012. And I, here in Southern California and Los Angeles, I owned 2 properties myself during the years of 2007 to 2012. And it was certainly very painful time because of property values going down. But outside of that, if you take a long-term view, on average, property values go up. So if we take a look at the Federal Housing Finance Agency, the average U.S. home appreciated at an average of 4.4% from 1967 until now. Let's just say, here we are, it's April of 25, so let's just say 1967 until 2023, right? So a year ago. However, in between the years of something like 2020 and 2021, the median sales rose by 17%. So that's really high. So the fact is that, this appreciation is obviously happening all over the world, but, I live in Southern California. I'm in the United States, and in these 2 cases, we're looking at the United States. So let's just take an example and say you're going to purchase a property for $500,000. In this day and age, it might not be that easy. You might have to actually get a condo depending on what location. But let's just take $500,000. And we'll use a single family house as one single investment for $500,000. Let's keep the numbers simple. Let's say you put 10% down. So that's $50,000. So what's going to happen is that $50,000, you put it down, and let's just say hypothetically that your mortgage is going to be $450,000. Now the reality is that when you buy a place, obviously you're going to have things called closing costs and other things that might actually that will, increase, the amount that you have to put down and affect what your actual mortgage is. But basically, for this example, we're going to use 10% down to $50,000, and we're going to say, okay, the property appreciates at 5% annually. So if you take a look at 5% annually, at the end of 10 years, you're going to have a property that's worth $814,447.31. Now, keep in mind that, what you're going to want to do most likely is get a 30-year mortgage so that you have a reasonable amount of money in terms of the mortgage that you're paying down each month over those 10 years. So the reality is that your mortgage company is going to have their own way of calculating the principal payments. But for the purposes of this simple demonstration that I'm doing, let's just use 360 payments of $450,000. So if you do that, it's a very simple math of $1,250 per month. And if you do that, basically times 10 years of those monthly payments, that's going to be $150,000 that you're going to pay down. So that mortgage balance is going to go from $450 down to $300 according to that simple calculation. So now if you actually do, the math, you now have at the end of 10 years a property worth $14,447.31. And then you have your $300,000 mortgage balance. So obviously, we're going to see that you have a net worth or equity in that property of $514,447, assuming those figures. Now, as you may imagine, I mean, I think that if you're talking about something like middle America or undesirable areas, 5% seems to be very reasonable, conservative for the most part, especially in this day and age. Here we are in 2025, and properties, California is its own animal, but here in Southern California, property values are very high and they continue to go up, which is shocking to me even, right? But they do. Now, if we get a little bit more aggressive with this assumption, let's just say, for the argument's sake, for this second case, that we use 10% appreciation on average, and we'll say 10 years. If you like any of this content, if you are in a place where you like this rentals content, I have some links in the description. What you can do is you can click on the link, or also an email address. You can contact me if you're somebody that is, if you're interested in maybe speaking with somebody that's a little bit further ahead of you. I have something called an SMTR launch kit, short medium term rentals launch kit. Very inexpensive, and I also have a way to kind of work with people. Again, just very basic, simple coaching in various forms. So you go ahead and see those links in there. Also, you can consider subscribing to the channel or giving the video a like. And then you also, if you know somebody, maybe not yourself, but if you know somebody that might like this content, you can send it to them. Thank you. I know that is aggressive, but it still is not completely unreasonable, and it's fair for the purpose of this video. So if we take those same figures, you buy the property, $500,000, you get the mortgage, you put 10% down, $50,000, you have a mortgage for $450,000. So it's the same scenario. Your mortgage balance is going to be $300,000 at the end of those 10 years, assuming that you pay down $150,000 of that mortgage balance. But what's happened is, at assuming 10% appreciation per year, based off of your purchase price of $500,000 property value, you're looking at $1,296,871. So that means when you take away that mortgage balance at the end of 10 years, you're looking at property equity of $996,871. That is just the asset appreciation model. That doesn't even factor in profits. So now in this day and age, really, you can rent residential real estate in multiple ways. You can do it the way that you've always done it, Wealth 101, which is rent a property long-term unfurnished, where you don't provide any furnishings. But now in this day and age, you can do Airbnb, which is shorter term rentals, or you can also do what's called medium term rentals. Actually, one thing I do quite a bit is medium term rentals. I actually really enjoy it because it's a furnished property, right? So you have a property that's entirely furnished, just like Airbnb would be, but it's not the intensity of multiple bookings in a month, right? It's more like get people in for 30 days. Quite often, it's actually more than 30 days. And I personally work with different co-hosts and also insurance companies, and people go in for typically like 2 months, give you a notice if they want to extend after 30 days. And there, it's actually very similar to revenue to Airbnb. On average. Now, there are certain exquisite properties on Airbnb that can make like a lot of money in a month. I'm not really talking about those because those are, in most cases, edge cases. But you can also do kind of a hybrid model too. You can, rent out through Airbnb during the busy months, where it's a lot easier to get Airbnb bookings from, let's say, May to September. And then from September onward, you can then just do medium-term rentals. And that is potentially a strategy to really maximize, your revenue potential. Because even if you have a very competitive Airbnb, you're going to have a tough time, or really anyone's going to have a time, getting a lot of rentals from September into May. And the reality is that Airbnb has gotten so competitive. It's rather unbelievable. It's just not really, it's just not easy in any way, unless you're really like a super host, at the cutting edge. It can be quite difficult to compete with the top properties when it comes to short-term rentals. So the point is that this second piece is cash flow. So now the reality is if you're going to go in April of 2025, if you're going to go buy a property, especially in the Sun Belt, right, or in a popular area, it's going to be expensive. It just is what it is. In my case, I've actually owned my properties for a while, so the cash flow is actually rather attractive. So you might be in that situation. But the fact is that if you're going to go in and you're going to buy a property, you're going to have to factor that in. So your cash flow might not be as good, but at the same time, if you are doing furnished rentals and you're doing more like medium style furnished rentals and maybe doing some kind of blending in some short-term rentals in the busy time, like where it's easy to do it, May to September, you're going to see much more attractive average monthly cash flow than you would from a long-term unfurnished rental. So that's actually two ways that you actually can make money from the rentals. And as you can see, even if your profit margin rather thin, which most likely they will be, especially if you're starting to buy here in 2025, it just is what it is. But the reality is, if you can actually hold on to them, you can increase your net worth. And it's a great strategy, right? Especially when it comes to things like fighting inflation and the reality of inflation, or if you have kids, you need to put your kids through college. So the other factor that is huge when it comes to these rental properties and adding to your net worth is called depreciation. So depreciation is something that pretty much anybody that is a real estate investor utilizing investment properties can understand, because depreciation is a non-cash expense, which means that you pay any money to get depreciation month in, month out. It's just something that the government gives you, and they basically depreciate your property, the property value, over 30 years, right? So in my case, I think it's something like, just for two properties in Southern California, the depreciation is like $30,000 a year. So maybe you have high income from another business, or you have high income from your job or something like that. So that means that you'd be able to depreciate that against your income every single year. So that's the third. And then the fourth is, I guess we could talk about capital gains. I mean, it's not really that relevant, because the point of this video is that you would actually hold on to the property and not sell the property, right? But when if you're doing other investments and short-term capital gains tax, I mean, as long as you hold an investment for longer than a year, you'll get long-term capital gains tax. So obviously in real estate, you're going to clearly, more than likely, hold the property more than a year. So you get the benefit of not having short-term capital gains taxes from things like other investments, like investing in the stock market or doing options or other investments. Like I've got some resources where I've got a guide for anyone. I call it the SMTR launch kit. So you can grab that, and then also I do email coaching, so you can actually do that if you're interested. Other than that, thank you very much for watching, and have a great one.